Welcome. It is Will Allen with Sentara Capital. I hope you are doing well. Thank you for tuning in. The dog days of August are certainly here. It is hot, but for us here in the South, it means football season is right around the corner. It kicks off this weekend, so we're excited about that. We're not here today to talk about that, though. We want to address the stock market volatility that is kicked into high force here in August and go over the reasons. Let's get into it. August has seen the volatility in stock markets and bond markets really amped up. And there have been a couple reasons for that. I sent out an email and posted on our blog at sentaracapital.com. You can go to blog and see that last Friday. And I addressed this a little bit, but I wanted to do a video and talk a little bit more about the reasons we have seen volatility increase. And there are three things that I think really have led to this increased volatility for the market so far this month. The first one has been the rapid decline in interest rates in the last 3 to 4 weeks. What we have seen here in the U.S., the U.S. 10-year Treasury rate was over 2% just late in July, and it dropped to briefly under 1.5% as of last week. And that's a major decline in just about a 2-week period. And one of the things that really concerned investors about that is that many times when rates decline like that, and you see rates declining kind of all over the globe, it can be happening because the market participants are concerned that the economy is really slowing. And we also had something occur last week called a yield curve inversion, which, if you don't know what that is, you're not alone, but it has been in the media a lot lately. And that's basically when interest rates on bonds with longer maturities, like 10 years, for example, drop below interest rates for shorter term bonds. So last week, what happened? You had the 10-year Treasury bond rate go under the rate for a 2-year Treasury here in the U.S., which basically means you aren't getting paid for taking the additional risks, or you aren't getting compensated for the additional risks that you're taking on by investing in, say, a 10-year bond instead of a 2-year bond. And typically, you get a higher rate of return because you are taking risks. There can be higher inflation down the road. There may be less economic growth. And by the way, inflation does reduce the value of your payback, and that's a big problem for bond investors. But the bottom line was when this inversion happened last week for about an hour or two, and today is Thursday, August 22nd, and we're right there staring at an inversion happening again. I want to mention a couple things about that, because typically when an inversion happens, it means that the market is very concerned about economic growth, and oftentimes you see a recession take place 15 months, 18 months, 21 months later. It's not something that happens quickly. But normally the inversion happens because the Federal Reserve is raising interest rates. They're trying to get ahead of inflation. You have economic growth slowing. And so the financial conditions are getting a lot tighter, and that does slow down the economy. This time around, the opposite's happening. Rates are declining. The Federal Reserve cut interest rates in July. Very likely will cut them again here in September. So they're making it cheaper to borrow money, which typically is stimulative for growth. So this is not like many of the versions we've seen in the past. The other thing that I want to say is that we have around the globe, there's about $16 trillion of bonds that have negative interest rates now, and Europe is kind of the centerpiece of this. And what that means is you have a lot of investors around the world who, instead of having negative interest rates where they're basically paying governments for the right to invest there, they look around at rates here in the U.S. and say, hey, I can make 2% or I can make 2.5% there. And that looks like an amazing deal. And so you have a lot of money coming into the US and buying our bonds, which drives the interest rates lower. So I think the bottom line is you have a lot of distortions globally from years and years of 0% interest rates and quantitative easing, where these central banks have gone out and bought a lot of bonds. And that's having unintended consequences. And I think that's very likely what is driving this inverted yield curve, and the fact that the curve is flattened so much. We don't think that this is the market's telling us that the U.S. is heading into a recession here, and that we have major economic problems. But we'll have to keep watching, certainly. And I'll also say that many of these central banks are now going to do deeper cuts to interest rates, going even further into negative territory, to the point where it may be -1% or -1.5% yields on a lot of these bonds and of these key interest rates that the central bank set. And that to us is just a terrible idea. The bottom line is, in Japan and in Europe, where they've had rates at 0 or negative for the last 3 or 4 or 5 years, they haven't had any economic growth. Their economies have been very, very weak. If lower interest rates, if 0% interest rates solved the economic problems we had out there, Europe and Japan would be flourishing right now, but that's just not the case. Let's move on now to number 2, the second thing that's really caused the markets trouble. So in addition to the fact that interest rates really have declined rapidly here in the last 2 or 3 weeks, something else that has been bothering markets has been really poor economic data from a lot of economies around the globe. So in the last few weeks, we have heard from Germany, for example, which has been the strongest economic power in Europe. And they had second quarter GDP decline in that country, a contraction in their economy in the second quarter, which is really not good news. The UK, they are dealing with the uncertainty around Brexit. And that's kind of coming to a head there, but their economy also contracted in the second quarter. And then in China, you've had a lot of economic data that has weakened significantly to 25-year lows. And really in China, what's happening, the impact of the trade war and the tariffs that we have put on China has really been hurting them. And it slowed their economy. And growth in China, really, China is they are typically responsible for about a third of global growth. So when they start slowing, it really can be felt all around the world, and the markets have become concerned by what they've seen there. And so slowing economic data from around the globe certainly has also helped lead to the volatility we've seen in the markets in this last week. Let's look at the third reason now that we have seen volatility kick up. The third issue that I think has led to increased volatility in August revolves around the recent announcements from President Trump about what the new tariffs are going to be on additional goods coming in from China. Up until this point, about $300 billion worth of goods that we import had no tariff. And these goods are primarily goods that the U.S. consumer would be buying, so phones and clothes and shoes, etc. And early in August, President Trump announced that he was going to put a 10% tariff on these goods as of September 1st. The market went down when that announcement came out. And then about a week later, he announced he was going to delay those new tariffs on a lot of the goods until December 15th. And I think the issue is that it just has led to a lot of uncertainty with businesses not knowing how to plan. So that's something that I think has certainly caused some of the volatility. Now, I will add that we are in full agreement that something had to be done with China's theft of intellectual property and forcing companies, technology companies, to give away their tech secrets to Chinese companies if you want to do business there. There's been cyber espionage, a lot of stuff happening that China's gotten away with for a long, long time. And really now there's a pretty broad consensus that China has to be confronted from both Republicans and Democrats and leaders of other countries. And even from financial, like a lot of economists who like free markets and free trade. Um, but some of them may not like how the tariffs are being allocated here and how the announcements are taking place, because there is no doubt that the uncertainty around this issue can cause businesses to slow down a little bit and want to take a breath before certain expansion, especially when if some of the tariffs hit the U.S. consumer. So certainly the rapid decline in interest rates here in the last couple of weeks, combined with really poor economic data out of China and Germany and the UK, among others, combined with the uncertainty around recent tariff announcements, those things have certainly been of concern to the markets. But the bottom line, as we sit here today, the stock market has rallied back in the last week or so. And as we said last Friday in our blog post, the U.S. economy is doing really well. The U.S. consumer is on fire right now. In fact, just this week, we have had earnings reports from Target and Lowe's that were very, very good. In fact, Target stock was up almost 20% yesterday, its biggest increase in a day ever. Lowe's is at a 52-week high. So is Walmart. So is Home Depot. These companies are having very good results. The U.S. consumer is doing very good. We have very low unemployment rate. Wage growth's been very good in the last 6 to 9 months. And in addition to that, we have the fact that unemployment claims, which came out today, were near a 50-year low. So unemployment claims really are when workers who have been laid off go and file for unemployment. So it really gives us an idea, are companies laying off employees? And it's a great indicator of how employers feel about the short-term economic outlook, because they tend to start laying off workers when they get concerned, and that's just not happening. Also, the housing market has really firmed up recently. Mortgage rates have declined, so housing permits have really spiked. A lot of things that signal what do companies feel about the short term still looks very good here in the U.S. And as long as that's the case, all the recession fears that we heard last week when the yield curve inverted really to us is overblown. And as long as the U.S. consumer is doing well, it's hard to see the U.S. going into recession anytime soon. And if the U.S. doesn't go into recession anytime soon, we think markets can still move ahead. It's been a very, very good year for our portfolios, and I think it can get better. But we do want to pay attention to some of these concerns the markets have. We will continue to kind of evaluate the information, and we'll let you know if we make any changes in the portfolios moving forward. Again, hope you're doing well, staying cool, and we'll talk to you soon.